If you look out the window, you see a recession. You see help wanted signs disappearing. You see your grocery bill doubling. You see your friends getting laid off. You see small businesses boarding up their windows. You see a commercial real estate apocalypse where skyscrapers are selling for $1. The physical economy, the economy where you live, eat, and work, is screaming crisis. But then you look at your phone, you open the stocks app, and you see green. You see the S&P 500 hovering near all-time highs. You see the Dow Jones defying gravity. You see a headline saying GDP grows 3%. And you ask yourself the most important question in finance right now: am I crazy, or is the market lying? You are not crazy. The market is lying. We are living through the greatest financial illusion in human history. It is a Truman Show economy. Everything looks perfect on the set. The sun is shining. The actors are smiling. But if you walk to the edge of the horizon and touch the sky, you realize it's painted canvas. And behind that canvas is a terrifying void of debt, insolvency, and mathematical impossibility. So why hasn't it collapsed yet? Why, despite $38 trillion in debt, despite wars in the Middle East and Europe, despite inflation, did the market not go to zero? The answer is not resilience. The answer is rigging. The market hasn't collapsed because it is not allowed to collapse. Not yet. We are going to break down the three pillars that are holding up this artificial sky: the concentration distortion, the liquidity fraud drip, and the Plunge Protection Team. Part 1, the concentration distortion, the magnificent one. First, we have to look at the math of the S&P 500. Most people think the S&P 500 represents the American economy. It doesn't. It is a market cap weighted index. That means the biggest companies have the most influence. In 2026, the concentration has reached levels that would make a banana republic blush. For the last 2 years, we haven't had a bull market. We have had an NVIDIA market. We have had an AI market. If you strip away the Magnificent Seven, NVIDIA, Microsoft, Apple, Amazon, Google, Meta, Tesla, and look at the other 493 companies in the index, the S&P 500 is effectively flat or down. The S&P 493 is in a recession. The industrial companies, the consumer staples, the regional banks, they are bleeding. Their earnings are down. Their margins are crushed. But because the AI stocks have trillions of dollars in market cap, they drag the average up. It's like walking into a room with 499 homeless people and Elon Musk. The average net worth in that room is over $1 billion. But that doesn't mean the homeless people are rich. The stock market creates the illusion of wealth by hiding the poverty of the majority behind the success of the few. Investors are blindly buying index funds. They buy SPY or VOO thinking they are diversifying. They aren't. They are just buying more NVIDIA. This passive flow creates a self-fulfilling prophecy. Money pours into the index buys the biggest stocks go up, the index goes up, and more money pours in. It is a feedback loop, a passive bubble. But bubbles fueled by concentration are the most dangerous kind, because if just one of those pillars cracks, if NVIDIA misses an earnings report, or if the AI hype cools off by 10%, the entire index collapses. There is no support beneath it. Part 2, the stealth QE, the liquidity foredrip. The second reason the market hasn't collapsed is the Federal Reserve. Now, Jerome Powell will tell you he is quantitative tightening, QT. He says he is pulling money out of the system to fight inflation. He is lying by omission. While he pulls money out the front door, he is shoving it in the back door. We have to talk about the repo market and the Treasury General Account. Whenever the stock market wobbles, whenever we get close to the edge, suddenly, mysteriously, liquidity appears. In 2023, when the banks started failing, the Fed created the BTFP, Bank Term Funding Program. They printed hundreds of billions of dollars overnight to plug the holes. In 2024 and 2025, Janet Yellen, Treasury Secretary, manipulated the T-bill issuance. She issued short-term debt to drain money from the reverse repo facility and inject it into the markets. It's technical, boring plumbing, but it is the reason you still have a job. They have effectively been doing stealth QE, quantitative easing. Think of the stock market like a junkie. It needs a fix of liquidity every day. If the Fed stops the fix, the junkie crashes, withdrawal. So the Fed has been essentially microdosing the market. They inject just enough cash to keep the junkie standing, but not enough to trigger hyperinflation immediately. They are walking a tightrope. But why? Why are they terrified of a correction? Because of the wealth effect. The U.S. economy is 70% consumer spending. Consumers spend money when they feel rich. If the stock market crashes, the boomers, who hold all the assets, stop spending. They stop going to restaurants. They stop buying cars. If they stop spending, the economy collapses immediately. So the Fed must keep the stock market up to keep the illusion of prosperity alive. The stock market is no longer a reflection of the economy. It is the engine of the economy, and that is a recipe for disaster. Part 3. The Plunge Protection Team, the invisible hand. Now let's get into the conspiracy fact. Have you ever noticed that when the market is crashing, when it's down 3% or 4% in the morning, suddenly at 2 hours p.m., a mysterious buyer steps in? The chart creates a V shape. The panic stops. The market finishes green. Who buys when everyone else is panic selling? Who catches a falling knife? It's not a hedge fund. Hedge funds aren't charities. It is likely the Working Group on Financial Markets, colloquially known as the Plunge Protection Team, PPT. Established by Ronald Reagan after the 1987 crash, the PPT includes the Secretary of the Treasury, the Chairman of the Federal Reserve, the Chairman of the SEC, and the Chairman of the CFTC. Their mandate is to maintain orderly markets. What does orderly mean? It means don't let it crash. Legal experts and whistleblowers have argued for years that the PPT has the ability to intervene in the futures market. They can use major banks like JP Morgan as proxies to buy S&P 500 futures contracts during moments of extreme stress. They act as the buyer of last resort. This destroys true price discovery. In a free market, bad companies fail. In a free market, overvalued stocks crash. But we don't have a free market. We have a managed market. The put option is implicit. Investors know that if things get too bad, Uncle Sam will step in. This creates moral hazard. It encourages reckless gambling. Why bother hedging my risk? The Fed will save me. This is why valuations are insane. The price-to-earnings PE ratios are at historical highs because nobody fears the downside. Part 4. The insiders are selling. The smart money exit. So, if the game is rigged to go up, why worry? Why not just ride the wave? Because the people who built the wave are getting off. Look at the insider selling data. Jeff Bezos, Mark Zuckerberg, Elon Musk, the CEOs of the Fortune 500. They have been selling stock at the fastest pace in decades. Billions of dollars worth of shares. Why? If they believed the AI boom was going to last forever, if they believed the economy was strong, they would be buying or at least holding. They are selling. They are cashing out at the top. They are exchanging their overvalued paper for hard assets, ranches in Hawaii, bunkers in New Zealand, gold, land. They know the music is about to stop. They know that the stealth QE is running out of ammo. They know that the reverse repo facility is empty. They know that the refinancing wall for corporate debt is hitting in 2026. They are selling their shares to you, to the retail investor buying index funds, to the pension funds, to the 401k holders. This is the great distribution. The smart money hands the bag to the dumb money right before the crash. Part 5. The gravity event, why it ends. So, when does it break? What is the pin that pops the balloon? It's not one thing. It's the lag. Monetary policy works with a lag. When the Fed raised rates to 5.5%, it didn't hurt immediately. Companies had locked in low rates, but time is up. In 2026, corporate debt is rolling over. Zombie companies, companies that only survive on cheap debt, are starting to die. Bankruptcies are rising. Unemployment is ticking up, even though the fake government numbers hide it. The Mag 7 can hold up the index for a while, but they can't hold it up forever. Eventually, the consumer runs out of credit. Credit card delinquencies are skyrocketing. Auto loan defaults are skyrocketing. When the consumer stops buying iPhones and subscribing to ChatGPT, the earnings of the Mag 7 will crack. And when they crack, the passive bubble reverses. Selling begets selling. The PPT can stop a 5% drop. They can't stop a 40% liquidation event when the fundamentals collapse. We are standing on the edge of a cliff. But the Wile E. Coyote moment hasn't happened yet because we haven't looked down. The market is defying gravity because of pure belief. Belief in the Fed, belief in AI, belief in the soft landing, But belief is not a strategy. Math is a strategy. And the math says we are insolvent. The crash hasn't happened yet because the system is fighting for its life. They are throwing every trick in the book at it: rigged data, stealth liquidity, propaganda, but gravity always wins. The higher they hold it up, the harder it falls. We aren't looking at a correction. We are looking at a reset of valuations, a reset of wealth. So don't envy the green numbers on the screen. Envy the person who is prepared for when they turn red. Cash is trash in the long run, but cash is king in a crash. Gold is the only truth. Bitcoin is the lifeboat. Everything else is a fugazi. I will keep watching the reverse repo numbers. I will keep watching the insider sales. The cracks are forming. The dam is leaking. Don't be standing in the valley when it breaks. Subscribe to the channel. We look down when everyone else is looking up. I'll see you in the next video.